In 1875, a broke pig farmer from Ohio sat down at his kitchen table with a pencil, a stack of commodity price records, and a burning question that had been eating him alive for 2 straight years. That question was simple. Why did I lose everything? He wasn't an economist. He wasn't a banker. He didn't have a degree from Harvard or connections on Wall Street. He was a guy who had watched his entire livelihood vanish overnight during one of the worst financial panics in American history. And instead of accepting his fate, he decided to crack the code. What he drew on that piece of paper was not just a chart. It was a prophecy, a hand-sketched cycle of booms, busts, panics, and prosperity stretching out decades into the future. And here's what makes the hair on the back of your neck stand up. That chart, drawn 150 years ago, has been right over and over and over again in ways that make modern Wall Street analysts look like amateurs throwing darts in the dark. Now, before you roll your eyes and click away, hear me out. I am not here to sell you doomsday nonsense. I'm not going to tell you to go hide in a bunker with canned beans. What I am going to do is walk you through actual historical data, real patterns, and verifiable facts. And then you can decide for yourself what to do with that information. Because here's the thing, nobody in mainstream financial media is talking about right now. 2 of the most historically accurate economic timing mechanisms ever documented are converging on the same year. Not roughly the same period, not the same decade, the same year, 2026. The first is that farmer's chart. It is called the Benner cycle, and it has correctly flagged major market peaks and crashes for a century and a half. The second is something called the 18-year real estate cycle, tracked and popularized by British economist Fred Harrison, who used it to predict the 2008 crash years before it happened, back when everyone else was still popping champagne and flipping condos in Miami. Both of these cycles, operating completely independently of each other, built on completely different data sets, following a completely different logic, are landing on 2026 as a critical inflection point. One calls it the peak of good times. The other places it squarely in the danger zone of what economists call the winner's curse. Neither label sounds scary on the surface. Both are absolutely devastating when you understand what they actually mean. And if that's not enough to get your attention, there's a third clock ticking in the background. The 4-year cryptocurrency cycle, driven by Bitcoin's halving mechanism, is also projecting its post-halving peak into late 2025 or early to mid-2026 territory. 3 independent cycles, 3 different asset classes, 1 convergence point. Now let me be crystal clear before we go any further. This video is for educational purposes. I'm not a licensed financial advisor. Nothing in this video constitutes investment advice. Markets are unpredictable and past patterns do not guarantee future results. Anyone who tells you they know exactly what the market will do next is lying to you. What I am doing here is presenting historical research, documented cycles, and publicly available data so you can think critically about the financial landscape we're all living in right now. Because what concerns me is not whether these cycles are perfect. No model is perfect. What concerns me is the pattern of behavior I see happening all around us right now. Regular people are taking on record levels of debt. Housing prices in major markets are at levels that would have seemed insane just 5 years ago. The stock market keeps hitting new highs while the underlying economy sends mixed signals at best. Everywhere I look, I see confidence, euphoria even. And historically speaking, that kind of universal optimism has been the single most reliable warning sign that a major correction is coming. So in this video, we are going to do a deep dive. We are going to start with that broke farmer and his mysterious chart. We are going to trace the Benner cycle through 150 years of financial history and see exactly where it says we are right now. Then we are going to layer on the 18-year real estate cycle and show you why it is pointing to the exact same moment. Then we are going to look at what the smart money, the institutional investors, the billionaires, the people who actually move markets, what they are doing right now while the rest of us scroll social media and assume everything is fine. By the end of this video, you're going to understand something that took me months of research to piece together. And once you see it, you cannot unsee it. Let's start at the beginning. The year was 1873, and America was riding high. The post-Civil War economy was booming. Railroads were expanding like wildfire across the continent. Speculation was everywhere. Banks were lending money like it grew on trees. Sound familiar? Samuel Benner was a pig farmer in Ohio. He was doing well. He had built a prosperous operation, and like a lot of Americans at that time, he felt like the good times would keep rolling forever. Then, on September 18, 1873, the investment bank J. Cook & Company collapsed. It was one of the most prestigious financial institutions in the country, heavily invested in railroad construction. When it went under, it triggered a chain reaction that would become known as the Panic of 1873. Banks failed. The New York Stock Exchange shut down for 10 days. 10 days. Let that sink in. Businesses across the country folded. Unemployment skyrocketed. And Samuel Benner, along with thousands of other farmers and small business owners, was completely and utterly wiped out. Now, most people in that situation would have just tried to pick up the pieces and move on. But Benner was different. He was obsessed with one question. Was this random, or was there a pattern? Could financial destruction on this scale actually be predicted? So he started digging. He went back through decades of commodity price records. He studied pig iron prices, which was a key industrial commodity at the time, sort of like what oil or semiconductors are to our modern economy. He tracked corn prices. He analyzed cotton. He looked at everything he could get his hands on, and he started to notice something that changed his life. The prices were not random. They moved in waves. Predictable, rhythmic, recurring waves. And those waves were not just visible in one commodity. They showed up across multiple markets, across multiple decades, as if the entire economy was breathing in and out according to some hidden clock. In 1875, Benner published his findings in a book called Benner's Prophecies of Future Ups and Downs in Prices. In that book, he laid out a chart that divided time into recurring cycles of prosperity, recession, and panic. He identified 3 rotating intervals for price peaks. They ran in a pattern of roughly 8 years, then 9 years, then 10 years, repeating over and over. For bottoms, he found an 11-year cycle. And when he mapped it all out, the chart stretched far into the future, making specific predictions about when prices would peak and when they would crash. And here is the part that should make every skeptic at least pause. His predictions were remarkably accurate. He called the Panic of 1891. He flagged 1902 as a peak. He identified major turning points in 1910 and 1919. When you overlay his chart against actual market data from the late 1800s through the 20th century, the alignment is genuinely unsettling. But the one that really gets people is 1929. Benner's chart, drawn 54 years before the Great Depression, identified 1929 as a year of panic, a year of catastrophic bottom, the single worst financial collapse in modern American history, and a pig farmer from Ohio essentially had it circled on a piece of paper half a century before it happened. Now, I want to be careful here because there is a tendency in videos like this to cherry-pick the hits and ignore the misses. And yes, the Benner cycle is not 100% accurate. No cycle is. There are years where the timing is off by a year or two. There are periods where external shocks like world wars disrupt the natural rhythm. That is the reality of any long-term pattern applied to something as complex as a global economy. But the broader directional accuracy of this chart over 150 years is hard to dismiss as coincidence. And when you look at more recent history, the pattern continues to show up. The early 2000s recession, the 2008 financial crisis, the 2020 pandemic crash, all of these align with periods that the Benner cycle would have flagged as vulnerable. What Benner discovered, whether he fully understood it at the time or not, was something that modern behavioral economists have spent decades trying to quantify. Human beings are cyclical creatures. We get greedy at the same rate. We panic at the same rate. We forget the lessons of the last crash at a predictable speed and pile back into risk with the same blind optimism our grandparents had. The cycle is not really about commodity prices or interest rates or housing starts. The cycle is about us, about human nature. And human nature does not change. So where does the Benner cycle say we are right now? That is where it gets really interesting. If you pull up the Benner cycle chart today, and I am talking about the actual chart that has been reproduced and studied by analysts for over a century, the period around 2026 falls into what Benner labeled as a year of good times and peak high prices. Now on the surface, that sounds great. Good times, peak high prices. Who wouldn't want that? But if you actually understand how the Benner cycle works, that label is not a celebration. It is a warning siren. In Benner's framework, good times does not mean things are going to be good going forward. It means things feel good right now. It means asset prices are at their maximum. It means optimism is at its peak. It means everyone, and I mean everyone, is convinced that the economy is strong and the markets are only going up. And it means you are standing on the edge of a cliff. Because in the Benner cycle, good times is immediately followed by the descent into what he called hard times. That is the contraction phase. That is where prices fall, credit tightens, businesses struggle, and the people who bought at the top spend years underwater. Think about it like a party. Good times is not the moment you should be showing up. Good times is 2 a.m. The music is still loud, everyone is still dancing, but the smart people left an hour ago. The people who are still there are the ones who are going to wake up with the worst hangover of their lives. And this is the part that really matters for anyone watching this video right now. If the Benner cycle is even directionally correct, then the period we are living through right this moment is the final stretch of a prosperity phase. The last window where prices are elevated, where confidence is high, and where you still have time to make strategic decisions before the music stops. Let me give you some historical context to show why this pattern matters so much. In the years leading up to every major good times peak in Benner's chart, you see the same setup: asset prices running hot, public participation in speculative investments reaching extreme levels, media narratives about a new era of prosperity, a widespread belief that this time is different. We saw it before 1929, the Roaring Twenties. Stocks could only go up. Regular people were buying shares on margin, borrowing money to invest in a market that felt like a guaranteed win. We all know how that ended. We saw it before 2000, the dot-com bubble. Companies with no revenue and no path to profitability were being valued at billions of dollars. Everyone was a genius stock picker. CNBC was the most watched channel in America. Then the NASDAQ dropped nearly 80%. We saw it before 2008. Housing prices had never gone down, they told us. Real estate was a sure thing. People were taking out adjustable rate mortgages on homes they couldn't afford because prices would just keep climbing. Then the entire global financial system nearly collapsed. And what do we see right now? In 2024 and heading into 2025, we see the stock market at or near all-time highs. We see artificial intelligence being hailed as a once-in-a-generation technological revolution that will transform every industry. And the stocks associated with it are being priced as if that transformation has already happened. We see meme coins and speculative crypto tokens generating billions in market cap based on nothing but hype and social media momentum. We see housing prices in many major markets still sitting at levels that are objectively unaffordable for the average family. Does that mean a crash is guaranteed? No, absolutely not. I want to be very clear about that. No chart, no cycle, no model can guarantee what the market will do. Anyone who claims otherwise is not being honest with you. But what it does mean is that the conditions we are seeing right now are exactly, and I mean exactly, the type of conditions that have preceded every major peak in the Benner cycle's 150-year history. The euphoria, the speculation, the unshakable public confidence, it is all here. And when you combine that with the fact that the chart itself is pointing to 2026 as a peak year, you have to at least ask yourself the question, what if this time is not different? What if the oldest pattern in financial history is about to play out again, right on schedule? Now at this point, if I were only talking about the Benner cycle, you might reasonably say, okay, interesting historical pattern, but one chart from the 1800s is not enough to base serious financial decisions on. And you would be right to say that. One cycle is a curiosity, but two cycles converging on the same year, that is something else entirely. And that brings us to the second clock. In the early 2000s, a British economist named Fred Harrison did something that made a lot of powerful people very uncomfortable. He predicted, in writing, that a massive real estate crash was coming and that it would trigger a global financial crisis. He made this prediction in 2005, 3 full years before it happened. And he was not guessing, he was reading a clock. The clock he was reading is called the 18-year real estate cycle, and it is one of the most well-documented patterns in economic history, even though most people have never heard of it. Harrison laid it out in detail in his books, including The Power in the Land and Boom Bust, where he traced this cycle back over 200 years of land and property data. The basic idea is this: real estate markets, specifically land values, move in a roughly 18-year cycle from boom to bust and back again. Not stocks, not bonds. Land. Because at the end of the day, land is the most fundamental economic asset there is. Everything is built on land. Every business, every home, every factory, every data center. And the price of land, according to Harrison and the economists who came before him, follows a rhythm that is driven by credit expansion, speculation, government policy, and that same relentless engine of human psychology we talked about with the Benner cycle. Let me walk you through the historical evidence because it is genuinely striking. The Panic of 1818, a land speculation bubble followed by a severe crash. Then, roughly 18 years later, the Panic of 1837, another land boom gone bust. Then, 1857, another panic. 1873, the same crash that wiped out Samuel Benner. 1892, 1907. You see where this is going? Each of these crashes was preceded by a period of intense land speculation, easy credit, rising prices. A widespread belief that property values could only go up, and then the bubble burst and the economy went into a prolonged contraction. Moving into the 20th century, the pattern continued. The real estate boom of the 1920s peaked around 1926, a few years before the stock market crash of 1929. The next major real estate peak came in the early 1970s, right before the brutal recession of 1973 to 1975. Then came the late 1980s property boom, which peaked around 1989 and was followed by a severe downturn in the early 1990s. And then, right on schedule, 18 years later, the mid-2000s housing bubble peaked in 2006 to 2007 and triggered the worst financial crisis since the Great Depression. Now, let me do the math for you because this is the part that should have your full attention. If the last major real estate crash bottomed out around 2008 to 2009, and you add 18 years, where do you land? 2026 to 2027. That is not my opinion. That is just arithmetic applied to a historical pattern that has repeated with remarkable consistency for over 2 centuries. But the cycle is not just about the peak year. It is about the phases that lead up to it. Harrison broke the 18-year cycle into distinct stages, and understanding where we are within those stages right now is crucial. The first phase, which lasts roughly 7 years after a crash, is the recovery. This is where land values bottom out, credit is tight, and nobody wants to touch real estate. We saw this from about 2009 to 2015. Remember those years? Housing was cheap. Nobody was talking about real estate as an investment. People were still traumatized from the crash. The second phase is the mid-cycle wobble. About 7 to 8 years into the recovery, there's usually a brief pullback or correction. Some analysts point to the period around 2015 to 2016 as fitting this pattern, when various global markets experienced uncertainty and housing price growth temporarily stalled in some regions. And then comes the third phase. This is the one that matters most. It is the explosive final boom. The last 4 to 5 years of the cycle, where prices go parabolic, speculation reaches a frenzy, and everyone piles in because they are terrified of being left behind. This phase is where the real damage gets done, because it is where the most people buy in at the highest prices, right before the whole thing comes crashing down. If the cycle is holding, we entered that final explosive phase around 2020 to 2021. And if history is any guide, it peaks somewhere around 2025 to 2026. There's a concept in economics called the winner's curse. It originally comes from auction theory. The idea is simple but brutal. In a competitive auction, the person who wins is often the person who overpaid the most. They won the item, but they paid more than it was actually worth. Their victory is their punishment. Fred Harrison and other cycle researchers have applied this concept to the final phase of the 18-year real estate cycle, and it fits like a glove. In the last years of a property boom, the people who buy are the winners in the sense that they managed to close deals in an insanely competitive market. They beat out other bidders. They waived inspections. They offered above asking price. They stretched their budgets to the absolute limit. They won the house. And then, when the cycle turns, they discover that they bought at the exact worst possible time. Their home is now worth less than what they paid. They are locked into a mortgage. They cannot refinance. They are trapped. That is the winner's curse. And if you look at the real estate market over the past few years, you can see it unfolding in real time. Let me give you some numbers. According to the National Association of Realtors, the median existing home price in the United States hit a record high of $426,200 in June 2024. To put that in perspective, in 2012, the median was roughly $154,000. That is nearly a threefold increase in just 12 years. Mortgage rates, which sat near historic lows during the pandemic, have climbed significantly. As of mid-2025, the average 30-year fixed mortgage rate is hovering in the high 6 to low 7% range, depending on the week. That means the monthly payment on a median-priced home has roughly doubled compared to what it was just 3 or 4 years ago. And yet, people are still buying. Not because the math makes sense, not because they have run the numbers and determined it is a sound long-term investment at these prices. They are buying because they are afraid. They are afraid that if they do not buy now, they will never be able to afford a home. They are afraid of being priced out forever. That fear has a name. It is called FOMO, fear of missing out. And it is the most powerful fuel source a late-stage bubble can have. This is not unique to our time. The exact same psychology played out before the 2008 crash. I remember the conversations. You have to buy now or you will never get in. Real estate always goes up. Renting is throwing money away. Those narratives were everywhere. They were in the media. They were at dinner parties. They were coming from real estate agents and mortgage brokers who had every financial incentive to keep the machine running. And the people who listened, the people who stretched to buy a home in 2005 or 2006 or 2007 because they were terrified of missing out, those were the people who got crushed the hardest. Some of them spent a decade in negative equity. Some of them lost their homes entirely. Some of them are still financially recovering to this day. The 18-year cycle suggests we are in the equivalent period right now. The final phase of euphoric buying, where prices are detached from fundamentals, where the narrative of prices only go up is accepted as gospel truth, and where the people who buy last are going to be holding the bag when the music stops. And it is not just residential real estate. Commercial real estate has been showing enormous stress, particularly in the office sector. Remote work has fundamentally changed how much office space companies need, and vacancy rates in many major cities are at levels not seen since the early 1990s. There are billions of dollars in commercial real estate loans that are going to need to be refinanced in the next couple of years at much higher interest rates. That is, a ticking time bomb that very few people are talking about. Meanwhile, land speculation, which is the core driver of the 18-year cycle, is visible everywhere if you know where to look. In fast-growing Sunbelt markets in the United States, in sprawling developments on the outskirts of major cities worldwide, in the bidding wars for agricultural land that is being rezoned for housing. The speculative frenzy around land is exactly what Harrison's model predicts for this stage of the cycle. So let me put this all together. The Benner cycle, built on 150 years of commodity price patterns and human behavior, flags 2026 as a good times peak followed by hard times. The 18-year real estate cycle, built on 2 centuries of land value data, places 2025 to 2026 squarely in the danger zone of the winner's curse. 2 completely independent systems, 2 different data sets, 2 different researchers working in different centuries, both pointing to the same moment. That is not proof that a crash is coming. I want to say that again clearly. This is not proof. Markets can defy patterns. Governments can intervene. Black swan events can accelerate or delay cycles. The future is fundamentally uncertain. But the convergence of these 2 well-documented historical patterns on the same time frame is, at the very least, something worth paying serious attention to. Now here is where the story takes a turn that I think is really important. Because while regular people are out there buying homes at record prices and pouring money into the stock market at all-time highs, there's a very different conversation happening behind closed doors. The big players, the institutional money, the people who manage billions and have access to research and data that you and I will never see, they are making very different moves. Let me walk you through what has been happening. Central banks around the world have been on a gold buying spree unlike anything we have seen in decades. According to the World Gold Council, central bank gold purchases in 2022 hit 1,136 tons, the highest level since records began in 1950. In 2023, they bought another 1,037 tons, and that pace has continued into 2024 and 2025. The People's Bank of China alone has been adding gold to its reserves month after month after month. Why? Why are the institutions that literally print money buying a physical metal as fast as they can get their hands on it? The answer, if you understand the cycles we have been talking about, is straightforward. They are preparing. They are hedging against a scenario where paper asset values decline sharply. Gold has been a store of value for thousands of years. It does not go to zero. It cannot be printed. It cannot be diluted. And in every major financial crisis in modern history, from the Great Depression to 2008 to the pandemic crash, gold has held its value or appreciated while other assets were falling apart. Silver tells a similar story, but with an additional twist. Silver is not just a precious metal. It is an industrial metal. It is essential in solar panels, electronics, medical devices, and a dozen other industries that are growing rapidly. The demand side of silver is enormous and expanding. Meanwhile, the supply side is constrained. Silver mine output has been relatively flat for years. Some analysts project significant supply deficits in the coming years. And yet, silver remains dramatically cheaper relative to gold compared to historical norms. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been sitting well above its long-term historical average. Some analysts argue that silver is one of the most undervalued hard assets on the planet right now. The point here is not to tell you to go buy gold or silver. Again, this is not financial advice. The point is to show you that there is a clear divergence between what the general public is doing and what the largest, most sophisticated financial players in the world are doing. The public is buying stocks at all-time highs. Institutions are stockpiling physical metals. The public is stretching to buy real estate at peak prices. Institutional investors in several markets have been net sellers of certain real estate holdings or shifting to more defensive positions. The public is confident that the economy is strong and that asset prices will continue to rise. The people who actually manage the largest pools of capital on earth are behaving as if they expect a significant disruption. This divergence is one of the most important signals you can watch. It shows up before every major market correction. The smart money moves first, quietly, while everyone else is still celebrating. By the time the general public realizes what is happening, the big players have already repositioned. Warren Buffett's Berkshire Hathaway has been sitting on a record cash pile. As of late 2024, Berkshire was holding well over $300 billion in cash and short-term treasury bills. Buffett, who has been investing for over 60 years and has arguably the best track record in the history of capital markets, is holding cash at levels that suggest he does not see compelling value in the current market. Think about that. The most successful investor alive, a man who has made his fortune by buying when others are fearful, is choosing to sit on the sidelines with hundreds of billions in dry powder. What does he know? Or more importantly, what does he see that the average investor scrolling through Reddit and TikTok does not? Again, I'm not claiming that Buffett is following the Benner cycle or the 18-year real estate cycle. He probably is not, but his behavior is perfectly consistent with what those cycles would predict for this stage. Late in the boom, when prices are extended and risk is elevated, the smartest players in the room start taking chips off the table. And they are not just sitting in cash, they are rotating into assets that perform well during periods of instability. Hard commodities, precious metals, energy infrastructure, things that have intrinsic value regardless of what the stock market or the housing market is doing. This is not conspiracy. This is just what smart capital allocation looks like when you believe a major cycle is approaching its end. Now, I promised earlier that we would talk about a third cycle, and this is where it gets really fascinating. Because layered on top of the Benner cycle and the 18-year real estate cycle, there is a modern phenomenon that did not exist when Samuel Benner was charting pig iron prices: cryptocurrency. Bitcoin, the largest and most established cryptocurrency, operates on a built-in 4-year cycle driven by an event called the halving. Every 4 years, the reward that Bitcoin miners receive for processing transactions is cut in half. This event reduces the rate of new Bitcoin supply entering the market, and historically, it has been followed by a massive price increase. Let me give you the data. The first halving occurred in November 2012. Bitcoin was trading around $12. Within about a year, it had risen to over $1,000. The second halving occurred in July 2016. Bitcoin was around $650. By December 2017, it had hit nearly $20,000. The third halving occurred in May 2020. Bitcoin was around $8,500. By November 2021, it had reached $69,000. The fourth halving occurred in April 2024. And if the historical pattern holds, the post-halving peak should arrive somewhere in the range of late 2025 to mid-2026. Do you see the convergence? The Benner cycle points to a 2026 peak. The 18-year real estate cycle points to a 2025 to 2026 danger zone. And now the 4-year Bitcoin halving cycle is projecting its own euphoric peak into the same window. 3 independent cycles, 3 completely different asset classes, 3 different underlying mechanisms, all landing on the same narrow band of time. And here is what is really important to understand about the crypto cycle specifically. Every single post-halving peak in Bitcoin's history has been followed by a devastating bear market. After the 2013 peak, Bitcoin dropped over 80%. After the 2017 peak, it dropped over 80% again. After the 2021 peak, it dropped roughly 77%. If the pattern holds, the euphoric peak we could see in 2025 or 2026 would be followed by a brutal crypto winter that could wipe out 70 to 80% of the value across the entire cryptocurrency market. And it would not just be Bitcoin. Altcoins, the smaller cryptocurrencies, typically drop 90% or more during crypto winters. Many go to zero entirely and never come back. So the picture that emerges when you put all 3 of these cycles together is one where 2025 and 2026 represent a period of maximum euphoria across virtually every major asset class. Stocks at all-time highs, real estate at all-time highs, crypto at all-time highs. Everything feels incredible, everyone feels wealthy. The narrative of permanent prosperity is everywhere. And then the tide goes out. So what do you actually do with this information? Let me be clear one more time. I'm not a financial advisor. I cannot tell you what to do with your money. What I can do is share the strategic frameworks that historically informed investors have used during similar periods, and you can decide for yourself what makes sense for your situation. The first principle is awareness. Simply knowing that these cycles exist and understanding where we might be within them puts you ahead of the vast majority of people. Most people have never heard of the Benner cycle. Most people have no idea that real estate follows an 18-year pattern. Most people will be completely blindsided if a major correction occurs. You will not be. The second principle is caution with leverage. Late-stage booms are the worst possible time to take on excessive debt. Whether that is a mortgage you can barely afford, margin debt in your brokerage account, or leveraged positions in crypto. If a correction comes and you are leveraged, you do not just lose money. You can lose everything. The people who get wiped out in crashes are almost always the people who were over-leveraged. The third principle is liquidity. Having cash or cash equivalents available during a downturn is not just defensive, it is offensive. The greatest wealth-building opportunities in history have come during crashes, when assets that were wildly overpriced suddenly become available at deep discounts. The people who had cash in 2009 could buy houses for pennies on the dollar. The people who had cash in March 2020 could buy stocks at generational lows. Cash is not just safety, it is optionality. The fourth principle is diversification into hard assets. This is where the central bank gold buying we discussed earlier comes in. Having a portion of your net worth in assets that hold intrinsic value regardless of market conditions, things like precious metals, commodities, productive agricultural land, has historically provided a buffer during periods of financial stress. These are not get-rich-quick investments. They are wealth preservation tools. And the fifth principle, and honestly this might be the most important one, is emotional discipline. The hardest part of navigating a late-stage boom is not the analysis. It is the psychology. When everyone around you is making money, when your neighbor just flipped a house for a $100,000 profit, when your coworker is bragging about his crypto portfolio, the pressure to go all in is enormous. It takes real discipline to step back, look at the bigger picture, and make decisions based on historical patterns rather than current emotions. Let me bring this full circle. In 1875, Samuel Benner sat at his kitchen table and drew a chart because he wanted to understand why he lost everything. He spent years studying price data, looking for the patterns that govern booms and busts. What he found was that financial cycles are driven not by random events, but by the predictable rhythms of human greed and fear. Those rhythms have not changed in 150 years. And his chart, remarkably, still resonates with the financial landscape we see today. Fred Harrison, working a century later with completely different data, arrived at a strikingly similar conclusion. Real estate markets follow an 18-year cycle driven by land speculation and credit expansion. That cycle has repeated for over 200 years, and it is pointing to 2025 to 2026 as the peak of the current boom. And now Bitcoin's own built-in cycle, a mechanical, mathematical process that was literally programmed into the protocol, is adding a third voice to the chorus. None of this is certain. The future is never certain. But when three independent clocks, built in different centuries, tracking different assets, driven by different mechanisms, all start ringing at the same time, the wise response is not to ignore them. The wise response is to prepare. I am not here to scare you. I am here to inform you. What you do with this information is entirely up to you. But I genuinely believe that the people who take the time to understand these patterns, who position themselves thoughtfully, and who resist the intoxicating pull of late-stage euphoria are going to be the ones who come through the next few years, not just intact, but stronger. History does not repeat exactly, but it rhymes. And right now, the rhyme is getting very, very loud. If this video made you think, hit the subscribe button, share it with someone who needs to see it, and drop a comment below telling me what you are doing to prepare. Are you holding cash? Moving into hard assets? Reducing debt? I want to hear from you. The clock is ticking. The question is whether you are listening. I will see you in the next one.